Hi, everybody. This is Alan Elman, the Blue Collar Investor, welcoming you to another one of our sample trade videos. This one, a real life example with Wheaton Precious Metals Corp, listed on the New York Stock Exchange under the ticker symbol WPM. Now, we're going to be using multiple 5-day covered call writing strikes taken from our premium stock report. So I entered these trades on September 15th, 2025 for a 5-day or 1 week expiration on 9/19/2025. I'm creating this video on Saturday morning, September 20th. So the trades are closed at this point in time, so I can give you my starting and final results. Okay, let's get started. First, why did I select Wheaton as one of my securities for my current portfolios? Well, you're looking now at a screenshot of the top portion of our weekly stock screen and watch list, which we provide to our premium members on a weekly basis, along with our weekly ETF report, monthly blue chip or Dow 30 report, and our quarterly high dividend yield report. But this is the weekly report from which I found Wheaton. So you could see here, I highlighted the row in yellow for you so you could see some of the reasons why it went through our rigorous screening process and actually made our list in bold, as you could see on the left. That means all the technical indicators were bullish. It was not a mixed chart. Now, it came from the IBD Big Cap 20, ranked number 9, so it was really strong from both fundamental and technical perspectives. You could see it's in the mining industry, which currently ranked A, and it was ranked A last week as well. And the mean analyst rating was a stellar 1.61, which is on a basis of 1 being the best and 5 being the worst. Another bullish signal was the on-balance volume with the up arrow, meaning more cash flowing in to the stock on up days than on down days. So all of that was extremely bullish. As I said, the technicals were all bullish. And if we look at it also has a dividend yield. If you look at the money implied volatility, 34.6. That means it's robust, but not crazy high and not too low where we might generate so-so premiums. So that's kind of right in our sweet spot over there. Now the option liquidity, as you can see, is good. That's what the Y means, is adequate option liquidity. And the earnings and ex-dividend dates do not interfere with this particular weekly trade. Next, I want to show you a 1-month chart of Wheaton and compare that to the market, the S&P 500. So Wheaton is this orange line on the top, and the S&P 500 is this blue line on the bottom. So you could see that at that point in time, when I entered the trades, Wheaton was up in the last month 13.65%. Wow. And the S&P in that same time frame, 2.5%. That's pretty good too, but Wheaton really was out of control heading to the moon. So that was another positive for Wheaton. Okay, so now let's look at the technical indicators we use in the BCI methodology for short-term option selling. And you can see here that number one, the moving averages, and we use exponential moving averages, were bullish. They were both ascending up. The blue shorter-term 20-day EMA was higher than the red 100-day EMA, all bullish. And the price bars or candlesticks, whichever you prefer, are at or above the 20-day EMA. So very bullish moving average or trend identifying indicator. Now, the MACD histogram, which is also a trend identifying indicator, as well as a momentum indicator, are these blue bars you see by number 2 where the green arrow is, and those are obviously above 0, another bullish signal. So far, 1 and 2 are great. Now, number 3 is the stochastic oscillator, this black line over here, and that's a momentum indicator, obviously ascending higher. So number 3, another bullish indicator. And it's all confirmed by number 4. The volume bars are holding up well. They're not fading out. No negative volume divergence. So overall, we look at this chart, and about 2 or 3 seconds later, we go, bullish chart. So that's another reason why I selected Wheaton for one of my portfolios. Now, turning to the option chain on 9/15, Wheaton was trading at 106.10. All right. So what I decided to do, and as those of you who've been following me over the past 18 years, and specifically now for the last 4 or 5 months, in the last 4 or 5 months of this year, I've been playing defensively. I just am not sure how the government policies are going to impact our economy and then our stock market. I just cannot quantify it, so I'm leaning defensive. So I selected the 102 in the money, which is a defensive play, 5-day expiration, expiring on 9/19, as I said, in the money call. That had a bid price of 456. Now that's not all profit, right? Because Wheaton's trading at 106.10. If we sell at 102, we've lost 410. So we have to deduct that from the 456. As you'll see in the next screenshot, the spreadsheet does that for us, trade management calculator. Now, I also did one contract. I did 3 of those. I did one contract of the 110 out of the money. So I did 3 in the money defensive, 1 out of the money more traditional. And that had a bid price of 43 cents a share, $43 for the contract. So the takeaway here is that out of the money calls offer 2 income stream potential, one from the premium and another from share appreciation. Will Wheaton go up higher from 106.10 up to or beyond the 110 or somewhere in between? Well, we'll be able to give you that final answer in this video. Now, the in the money calls, the 102, lowers your break even because it has an intrinsic value component. So you got a lot more protection to the downside. Okay, so there you go. 102 strike at 456, 110 strike at 43. Let's put that into our trade management calculator, TMC. You could see here at the top, we entered the price 106.10, the 2 strikes I just alluded to, the 2 premiums I just alluded to, and on the bottom now we get our calculation. So the spreadsheet said, yes, if taken through contract expiration, it's a 5-day trade. The break-even price points, as you could see, for the in the money is way lower, 101.54 from current 106.10, compared to the out of the money, which the break-even is 105.67. Let's look at the calculations. Now, for the in the money strike, the spreadsheet will break down the 456 into 46 cents of time value and $4.10 of intrinsic value. So the actual profit is the 46 cents. And based on the cost basis, that's a return of 0.45% based on a 5-day trade that annualizes out to a very robust 32.92%. Okay, that's the in the money strike, which also, if you look at the purple cell, has downside protection of that time value profit of 3.86%. That means that if the price of Wheaton goes down by 3.86% or less, or goes up, we will have guaranteed our 0.45%, 32% annualized return. Now, looking at the 110 strike, that's all time value profit, that 43 cents, and that's almost the same as the in the money. It's 0.41%, 29.59% annualized. So the returns are very similar, but the 110 strike offers upside potential, which the in the money strike does not. And that's 3.68%. So we could get, if Wheaton moves up to the out of the money 110 strike, we can end up with a return of 4% in 4 days, 0.41 and 3.68, most of it share appreciation. All right. So let's have a look now at how much we generated in time value. That's actual profit, but the trade is unrealized at this point in time because we still didn't sell the shares. We don't know what's going to happen. But the total premium time value, okay, let me stress that time value premium collected was $181 for the 4 contracts, the 138 for the in the money and the 43 for the out of the money. All right, now let me show you the initial, not the final, but the initial total portfolio returns. It's 4 contracts. We collected 181. we have the potential of an additional $390 max return on the share appreciation, which would then be added to the 181 if that happens. Now, the total max return, 571. The capital invested after deducting intrinsic value is 33,340, and that results in a flat return. In other words, no share appreciation of 0.54%. Added on to the upside would be 1.71%. But the flat return annualizes out to over 39% when you add in all four contracts and average it out. It's 39.42% annualized. Now, with the upside, that would annualize out to this ridiculous number here, 124.83% if we get our max return. Okay, well, now let's take you to right now, present time. It's Saturday morning, September 20th. I already know what happened. Here are the results. Wheaton closed Friday at 4 p.m. Eastern time at 107.65. It was up actually $1.55 from the trade entry price. So that was good. Now, the 102 in the money strike, remember, I sold 3 contracts of that. That had a stop loss, which I completely expected, of $4.10. Remember, I bought the shares at 106.10, and I sold it at my contractual obligation, 102. And that means for the 3 contracts on the stock side, I was down $1,230. But wait, there's more, as the commercials say. The option gain was 456, and that for the 3 contracts tallies up to 1368. So the net gain on the 102 strike was $138. All right, now let's move on to the 110 strike, which had some good news associated with it. The unrealized stock gain, as I mentioned, unrealized because I haven't sold the shares yet, is $1.55 a share, or $155 because I did only 1 contract of this out of the money strike. Now, the option gain was $43. So the total realized / unrealized gain for that 1 contract is $198. So the total gain when adding on the 198 to the 138 is $336. Our cost basis was $42,440. That's what it cost me to buy the 400 shares. That results in a 5-day percent return of 0.79%. And if we were to annualize that out, it annualizes to 57.85%. So you could really see how important it is to use percentiles rather than dollar amounts when actually getting a good idea as to the kind of results you're receiving. So these results I would call spectacular. Now, I always share with you, or most of my trades have been winning ones so far this year because I've been going defensively. But when I have losing trades, I'll share those with you as well, let you know what I did. And so we can all learn from these trades, including me. So what is the status now of the 400 shares that I purchased on Monday? Well, 300 was sold because I allowed exercise. I could have bought back the option to avoid exercise, but I decided to let the shares go. Now, I still hold in my portfolio 100 shares of Wheaton. Now, on Monday, if those shares open significantly higher, and what I typically do in that case, if there's a real pop, I very well might sell the shares and lock in my profit. But if Wheaton just moves up or down just a little bit, which is, the more likely scenario, then I will most likely write another covered call on that. I'm certain that Wheaton is going to be in the upcoming stock report that we're going to provide to our premium members that'll be published late tonight because the fundamentals didn't change and the technicals were good because it actually went up in value over the last 5 days. So let's summarize now. Significant returns can be generated with a 5-day laddered covered call trade, laddered in terms of different strikes for the same expiration. Now, we can craft our option trades to align with what's going on in the market today and our personal risk tolerance. As I told you earlier, I am a bit concerned about, government policy impacting our economy and perhaps the stock market. Stated more accurately, I just can't quantify how it will impact. So I'm erring on the defensive side with my portfolios. Now, we were able to generate a very significant initial return, and it resulted in a very successful overall outcome after the contracts expired. And I always want to reiterate that these are low risk, not no risk trades. When we're looking to beat risk-free returns, by definition, we're always incurring some degree of risk. Now, when you take a defensive posture, like I did with these trades or three of the contracts anyway, our risk is even lower than it would be for traditional, where it's already low. So, ladies and gentlemen, that ends another one of our sample trade videos, a real-life example with Wheaton Precious Metal. This was a multiple strike 5-day covered call trade taken from our premium stock report. As always, I always hope that you learn and benefit from these sample trades, as I do. And I thank you very much for listening to this video. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.